As we're near the end of this course, I wanted to go out with a bang. That is, I wanted to end with something very interesting and compelling. And, well, honestly, I can think of hardly anything more interesting than accounting. That's right, accounting. You know, that process of keeping track of money, how much comes in and how much goes out, so that a business always knows exactly where their money is going, as well as how much they have. So I think we can all agree that few things exist more interesting than accounting. In case you can't tell, I'm joking. I'm not crazy. I don't think accounting is inherently all that interesting. But the concepts and vocabulary of accounting can be quite essential when trying to learn business English. And as usual, I'm going to try and make them easier and funner to understand by looking at an interesting case study. As an introduction, imagine one of the most powerful companies in the world right now. What comes to mind? Apple? Google? Amazon? Microsoft? Well, imagine if from one day to the next, Apple suddenly went bankrupt and that it lost so much value that it could no longer stay in business. This is nearly impossible to imagine, right? Apple going out of business? Well, the same thing basically happened in the early 2000s. And if you were born before 1985, you might already know what I'm talking about. I'm talking about Enron. And today we're going to look at the famous scandal that destroyed this company. If you haven't heard of Enron, don't worry. By the end of this lesson, you'll have learned all the ins and outs or essentials about this once unrivaled giant in the industry. So, without further ado, let's get down to brass tacks. Like I said, the Enron scandal was, at least in America, one of the biggest events in the news cycle back in the early 2000s. It's one of the most infamous examples of white-collar crime or corporate fraud in all of history. In fact, the outcome of this scandal led to significant changes in how companies are now regulated in the United States. At the time, the company Enron, which sold electricity and natural gas, was one of, if not the most successful energy companies. Yet, as we shall see, behind this impressive image was hiding massive financial problems. Eventually, these issues came to light in a rather dramatic way, and investors, employees, and even the general public were shocked by what was going on. Okay, for starters, Enron was founded in 1985 after the merger of two companies, Houston Natural Gas and Internorth. Enron was based in Houston, Texas, and as I mentioned, originally focused on the energy sector, including natural gas and electricity. But under the leadership of CEO Kenneth Lay, Enron expanded rapidly and began to venture into new areas, including energy trading and high-speed internet, which was called broadband at that time. In fact, by the 1990s, Enron was widely regarded as one of the most innovative and successful companies in the world. It was consistently ranked among the top companies in the Fortune 500, and its stock prices soared. But, as I've alluded to, this stock price was built on a foundation of deception and fraudulent accounting practices. To understand this, it won't be easy, as even business experts found Enron's business model complex and difficult to understand. But let's try. I think you can manage. So, like I said, the company was heavily involved in energy trading, meaning they bought and sold energy contracts. Basically, they bought energy from other companies that generated energy and then sold it to businesses that needed this energy. Well, it turns out this trading was highly profitable, and Enron quickly became a dominant player in the energy markets. As I mentioned earlier, Enron also invested in new technologies and other projects, including broadband internet. Well, here's where the problem starts. Because Enron claimed that these ventures or projects would be highly profitable in the future, and this is what kept its stock price high. Unfortunately for Enron, and unfortunately for Enron's investors, many of these projects were risky and failed to generate the expected returns, or ROIs. But Enron didn't want their investors to find out. So this is where the shady behavior began. To hide the financial losses from these ventures, and to give the image that they were still really profitable, Enron started a series of complex and fraudulent accounting practices. Practices that eventually led to the company's downfall. So, as promised, let's look at some of these fraudulent accounting practices. In a nutshell, Enron's fraud was centered around its use of special purpose entities, or SPEs. An entity, by the way, is a common word in business, and it refers to any organization or company that operates as a separate unit. An entity is viewed as an independent person in a legal context, which means that an entity can own property and enter into contracts. In any case, these entities, these SPEs, they were legally separate from Enron, but were used to keep debts and losses off Enron's balance sheet. A balance sheet is a really important financial document which shows all of what a company owns or its assets. And on the other side, it shows what a company owes or its liabilities, the things it needs to pay. So Enron used these special purpose entities to hide debt that should have been on their balance sheet. Obviously, this made their financial situation appear much better than it really was. And obviously, this was fraud and illegal. But that's not all. Enron also used a controversial accounting method known as mark-to-market accounting. Now, bear with me, because this gets a little technical. Basically, this mark-to-method approach allowed Enron to record future profits as if they were current profits. In other words, imagine you have a friend who says their bike is worth $1,000, even though they haven't sold it yet. Then, one day, this friend updates their personal savings by adding that $1,000. Even though no one has actually paid them for the bike. But this friend keeps telling everyone they're richer because they believe that one day their bike will sell for that price. Now, obviously, in reality, the bike may never sell for that price. And basically, this is exactly what Enron was doing, just on a massive scale. To be fair, this type of mark-to-market accounting is not illegal. But it is sometimes controversial, as we can now understand why. And as we've seen, companies like Enron can use it to manipulate their balance sheets.